Hi, I'm Sam Meredith, and joining me today to discuss the UK economy is Kallum Pickering, a senior economist with Berenberg Bank. So Kallum, we have seen that UK inflation unexpectedly rose to 0.1% in July, which is a boost, though it's now been 18 months since CPI was last at the bank's goal of 2%. Can we expect UK inflation to reach this target in the near future?
It depends on your view of the near future. I think late 2016 to early 2017 seems most likely when you look at the projections of the key drivers. So, low commodity prices and the impact of falling oil price in particular should drop out of the headline measure next year, and this will boost inflation. Strong sterling on the back of expectations of a rate rise and strength in the UK economy will persist so long as the UK maintains its relative position and whilst its main trading partners, the Eurozone in particular, ease monetary policy. This could drag on prices into the long term. Finally, tightness in the labour market and in turn wage growth will help boost the price level. This will deliver gradual growth in prices. Indeed, this is already showing up in the estimates for core prices, with data surprising the upside today by 0.3 percentage points. So, how does this work? Further improvements in the labour market will drive increased gains in wages as firms compete for workers. As workers earn more, they'll raise their consumption level, and this raises prices. This will be the key driver of the upturn, and we expect it to happen over the course of the next 18 months when unemployment falls from its current rate of 5.6% to 5% in our projections.
The pound jumped against the euro with the news that inflation had risen slightly. The strength of the UK currency has increased by 20% over the past couple of years, which has put downward pressure on inflation overall. But despite this, is there a building case for an interest rate rise in the UK?
Yes, of course. I think Q1 2016 is our central view, and coincidentally the strengthening sterling is partly a secondary effect of the expectations of a rate rise. So if you think of it this way, a central bank typically expands policy during phases of economic weakness and contracts during phases of strength. So the fact that markets are recognising strength in the UK economy and raising their demand for sterling, the Bank of England is also recognising the same strength, and then this puts them in a position to think about raising rates.
The bank governor, Mark Carney, has hinted that the start of 2016 could be a suitable time to negotiate a rate hike. Is holding off on a rate rise until inflation improves the best strategy, or does maintaining record low levels risk distorting the economy?
Well, of course, monetary policy works with a lag. So for the MPC at the Bank of England, they'll make changes now, given what they have in mind for economic conditions in the future. So if they don't vote for a rate rise, it's because they don't think future economic conditions are going to be suitable. But in my mind, when we talk about the distortions, the obvious one regarding monetary policy is runaway inflation. But at the moment, we know inflation is low. I think the probability of it running away going forward is quite low too. Your transient components that can hit the headline, like commodity prices, can have big temporary shocks. But the Bank of England and economists, markets, look through these to the core drivers. And if we think about the sorts of core drivers which can generate runaway inflation, the obvious one is excessive growth in the money supply. This is where banks issue too many loans, given the amount of goods and services that the economy is producing. But in the UK, the money supply, if you measure it by M4, has seen very little growth in the last 5 years, and that's come against increases in the production of goods and services, economic growth. So from a purely mathematical perspective, the prospects of surging inflation are very, very limited in my mind. In terms of timing, when we think about the lags, the Bank of England will wait until inflation, unemployment and GDP, the numbers look strong and stable. If you wait too long, then you risk distortions in the real economy, but I think this is a very low probability event, which is why so much weight is being applied to these individual data releases, such as today's numbers or unemployment last week. So Q1, from my mind, seems to be a sensible time when you can identify strength in GDP, improving inflation, low unemployment, and then the bank can act, taking into account the transmission and the likes, and it doesn't run the risk of being late and then allowing real distortions in the economy to manifest.
Thank you, Kallum. Be sure to check back with Jugoscopy for more updates throughout the week. Goodbye for now.